A second key element of government policy that can help to restore balance between spending and productive capacity in an economy is monetary policy. As the name suggests, monetary policy has to do with the availability of money, and changes in the availability of money affect interest rates. Changes in interest rates can affect economic activity. So the basic idea is that the interest rate is essentially the price that you pay in order to borrow money. So if you borrow money to buy a house, you pay an interest on the loan, and that interest is effectively the price that you pay for borrowing the money to buy the house. If the interest rate is high, you're paying a lot of money in order to borrow the money to buy the house, which means that if interest rates are high, you're less likely to borrow money to buy the house. The same sort of an argument applies to people who want to borrow money to build a factory, for example, or to buy new machinery for their business. If interest rates are high, the price of borrowing money to build those factories, to buy that machinery is high, and people are less likely to do that. So generally speaking, low interest rates tend to spur economic activity. They get people to borrow money to buy houses, invest in factories, invest in machines. That spending creates income for others who then go out and spend money on other things. Low interest rates increase economic activity. In contrast, high interest rates decrease economic activity because it makes it more expensive for people to borrow money to, for example, buy houses, buy cars, or to build factories, or to buy machinery. I'm not going to go into too much detail about this. This is mainly the subject of macroeconomics and other economic courses that you can take. But the basic point is that the central bank in the United States, which is the Federal Reserve, it can change the interest rates in the economy by increasing or decreasing the availability of money that banks and others can borrow. So in the United States and in most well-managed economies, the interest rates are used in order to try to keep the balance between productive capacity and spending. When the economy is growing slowly, interest rates are lowered. When the economy is growing fast, interest rates are typically raised. And let me write down what I'm talking about here. When spending is less than productive capacity, interest rates are lowered. When spending is threatening to exceed productive capacity, then interest rates are raised to try to cool the economy down, to try to limit borrowing and to limit spending.